Good morning, everyone. Welcome to Windsor Brokers live daily market outlook for Wednesday, 5th of December 2012. Highlights of the day come as follows. Signs in improvement in overall Eurozone conditions are maintaining the positive sentiment that was shown on the Euro's recent rally, unobstructed rally that currently holds above our initial psychological barrier at 131.00, as easing fears of Greece and Spain are basically boosting the positive sentiment. Efforts to tackle the debt problems in these two countries, with the dollar coming under increased pressure, are giving more boost to the single currency. The outlook from Greece and Spain, with Spain now injecting fresh funds into their banks, and Greece looking like it's on its way to secure more funding to the crisis-shook country, give the positive tone to the single currency. As we mentioned yesterday, 131 was in sight, and the bulls remain unobstructed. This was basically confirmed on the to the overnights and to this morning's rally of the single currency that broke above 131.00 and now opening way towards our key barriers at 131.38 and 131.70. From the other side, large scale of US dollars underperformance that boosts basically the counterpart currencies comes from the Republicans and Democrats' continuation of strategical and political strategies in order to exhaust their opponents. As clock continues to tick against both parties, they are on the way to whether find solution for so-called fiscal cliff or to trigger the fresh raise hike, tax hiking that it's worth, and the public spending that's worth approximately 600 billion US dollars. More signals of further uncertainty with in the current negotiations between two parties in America are quite likely, but some analysts see the potential for further delay of the deadline for finding a solution until basically the solution is found. As we mentioned in the past few sessions, that lacking to find solution and triggering this so-called fiscal cliff could be quite trigger for quite a disastrous scenario for the biggest world economy, as it would be falling into the recession. The U.S. economy, as we said, could slip into recession in case of a failure to find a deal or avoid a year-end budget crisis. And of course, President Obama said that the possibility of lowering tax rates in 2013 with the broad U.S. tax code revamp, but he's still firm in insisting rates for the wealthiest must rise as a part of a budget deal with the Congress. And basically, this is one of the, not one of the most important problem, and the main obstacle between two parties so far failing to reach the deal about this fiscal cliff. As said, the euro stands positive in the early hours of European session, holding above 131, while sterling is showing initial signs of weakness, despite corrective bounce, finding support just below 161, and a fresh move regained again 161 handle. More pressure is seen towards the downside due to some negative signals seen on the near-term technicals. We're going to elaborate this in our technical part more, while dollar yen avoids immediate downside risk after finding support at 81.70 near-term range floor and bouncing as high as 82.33. A signal for further sideways range trading is quite likely at this point, unless we see further lift above 82.50-60 that would refocus the upper boundary of the range. But in any case, a break of either side at this point is seen as a resumption of either uptrend or trigger for the corrective action. Dollar Swiss is again under increased pressure following brief corrective action and spike yesterday to level just under 93.00. That proves to be quite a strong barrier and not allowing any stronger corrective action, as overall tone for dollar Swiss remains quite negative, and the near-term focus is still at the downside. The recent low at 92.39 and the key support at 92.13. Crude oil ticks higher again after hitting a fresh high 2 days ago at 90.31, and the subsequent corrective pullback was initially contained at 88.50 with the spike lower down to 87.57, bringing more risk towards the downside, but fresh action higher now sees again focus towards the upside as pair approaches price approaches 89. Barrier, of course, still to see break above 89 2030 and the 90.31 in order to improve the structure. Gold is set is slightly higher following yesterday's fresh weakness and posting fresh low at 16.91. This was the level we mentioned in I think either in our yesterday's live session or in technical outlook for commodities. I mentioned clearly that a likely scenario would be further dip down to 16.91, and this is Fibonacci expansion. I think 38.2%, if I'm not mistaken. I don't have it in front of me at the moment. With the more focus seen towards the downside for the yellow metal as a continuation of the larger down move from 17.52 upside the rejection, and now sees focus at the downside after the gold price lost important support at 17.05 and 17.00. From today's calendar, we have a number of releases due today, but I would put a highlight on, apart from services PMIs that are due from a number of countries from Europe and the US, the ADP non-farm payrolls are, I would say, the top release for today, as we are having the US non-farm payrolls monthly release next coming in 2 days on Friday. And this is one of the indicators, not necessarily to be, but sometimes it gives a good indication for the US jobs data. ADP data for November are shown slightly below the October's release at 141,000 compared to 158, and this could be indication as the labor market in America is still struggling and still showing increased signs of weakness. We're going to see how the ADP will perform today, and we might judge for possible values that will be released on Friday on the US non-farm payrolls data, which is one of the top releases for this week. Just to take a look in the forecast for ADP, unfortunately we don't have it listed in one of the calendars. Most likely the other one will have it. Unemployment rate is expected to stay unchanged at 7.9%, while non-farm payrolls are forecasted Friday's release to dip significantly to 93,000. This is the forecast versus 171,000 of the month of October. Now we're going to take a look at today's ADP release to have a brief outlook how it's going to be on Friday. Other releases, services PMI from Spain, Italy, and Eurozone 1 due at 9 o'clock GMT. No change seen on today's forecast, 45.7, while UK's services PMI for November due at 9:30 are expected to tick higher. 51.1 is seen versus 50.6 in the month of November. US Eurozone retail sales due at 10 o'clock GMT are showing, according to the forecast, a slight improvement, but still a negative -0.1% forecast, -0.2% previous release. And as said, the non-farm ADP non-farm data are due at 13:15 GMT, and then at 13:30 we have the revised non-farm productivity that is forecasted at 2.7 compared to 1.9 release of previous month. revised unit labor cost for the third quarter is expected to further decrease, -0.9 is the forecast compared to -0.1 in second quarter, and the US ISM non-farm manufacturing PMI for November is, according to the forecast, showing a decrease from October's release at 54.2. Today's forecast is 53.8. US crude oil inventories, for some reason the calendar doesn't show draw of 100,000 barrels is forecasted for today's release compared to draw of 300,000 barrels in the last week. And then data from Bank of New Zealand, release of the cash rate and the press conference that will give the statement of the rate decision and monetary policy decisions, with the bank expected to stay pat at 2.5%, no change in the rates for the New Zealand. And now we're going to take a look at the currencies. I think we covered the most important news and the fundamentals. We're going to take a look in the major currencies and commodities and see the expectations and the forecasts for today's trading. As said, the euro is well supported and holding this morning above 131.00 with the fresh high seen at 131.25. As shown on the ADX studies, hourly bulls are firmly in play. For our bulls, the same situation. Also, the daily bulls are very strong. So the overall bullish tone for euro dollar remains unobstructed, as basically the straight line of the recent higher low at 128.79 is seen a steady rally that is looking for test, of course, of our initial barriers at 131.38 peak of 14th of October and 131.70 highs of 9th of 17th of October, 31.38, and then the two peaks at 131.70, 14th and 17th of September. These are our initial targets. Break above these levels, though some analysts expect this barrier to be quite tough and not to be clear, that the first attempt with some hesitation and the corrective consolidative action seen ahead. According to the technical outlook, the indicators are okay, except the hourly is quite positive, and they still see enough room for a break above this level. That is also seen as a trigger for the resumption of the broader uptrend from 120.42 yearly low of 24th of July, resumption of the broader uptrend that would be looking for a test of levels at 132 and 132.82. These are the peaks of end of April 2012, seen as the next targets in case of break. The uptrend was, of course, interrupted by this corrective action from 131.70 that found support at 126.60, and since then the euro is in ascending mode. We are talking about 2 weeks rally, that 2 or 3 weeks rally that is now targeting 131.38 and 131.70. Is the fears from Greece and Spain are additional boost from the fundamental side, with technicals being firmly positive, seeing no obstacles at this point for a test of two of our key upside barriers. On the downside, 131 acts as initial support. It's approximately also 20 days exponential moving average. More significant, I would say, is the one at 131 and 130.70. This is the low of, intraday low of yesterday and the previous high of 3rd of December. Then we have 130.46 intraday high of 3rd of December and the intraday low, of 4th of December. Basically, any dips should be contained by these levels or above 130.00, seen as a breakpoint. In case of any stronger reversal, 130 should contain the dips in order to keep immediate bulls in play for a test of our initial targets 131.38 and 131.70. Quite extended the conditions on the on the hourly chart, see potential for some corrective easing, I would say, at this point, but yet no any signal of RSI is now approaching overbought territory. MACD is quite stretched, while stochastic stays still within the lines, and it's in, I would say, in this case, in sideways mode. And all this leaves room for a possible stretch higher. Now it's a more psychological point whether the traders will jump for 131.38 and then 131.70 as a key barrier, or will see some profit taking. Most likely scenario would be a test of these levels, as according to the technicals the upside remains firmly in focus, as well as fundamentals that are so far being well supportive for the single currency. Most likely scenario is a test of our previously mentioned targets and barriers. Sterling from the other side comes under pressure again, following yesterday's stretch to fresh high at 161.29. We can see on the hourly chart that bulls are now losing traction following a corrective action from 161.29 down to 160.87, where the support was found. Subsequent bounce higher did not succeed so far. 160.119 seen, and then we have congestion here. Descending hourly indicators now see risk of further reversal, while 4-hour chart studies are in a rather sideways move. It's holding the positive territory, but some of the indicators already started to point lower. We can see the momentum is descending. Rate of change also breaking below the 7 days moving average. That could be initial signal of a possible reversal. In case of failure to regain 161.29, most likely scenario would be corrective action. Of course, break below 161.87 is required to confirm this failure swing and the open way for some stronger corrective action of the latest quite strong rally from low at 159.60 that peaked so far at 161.29. As said, failure to break above 161.29 might signal further consolidation, while break below 160.87 to trigger corrective action. We have immediate this 160.87 is reinforced by a 55 days exponential moving average that is now starting to move sideways, along with the 10 and the 20 days ones. That could be a signal of further hesitation, but of course break below 160.87, and I would say more significant 38.2% retracement at 160.75 required to confirm the near-term negative stance and allow for some stronger corrective action. From on the hourly chart, indicators are positive again, as said, starting to point lower. That could be initial signal. These 160.75, the Fibonacci support is also reinforced by 4 hours 20 days exponential moving average that could trigger a reversal down to strong support. Previous congestion top at 160.50 now reverted to support, and 160.00. 160.00. Break of 160.00 could be quite risky for the pair, as this could trigger some stronger corrective action. Conversely, break above 161.29 is to open way for a resumption of a larger uptrend from 158.26, as this is signal on quite positive daily studies that are now emerging above their midlines and seeing more room for a further extension higher, with 61.8% retracement of the downleg from 163.08 to 158.26, now offering initial barrier where the gains basically stalled, but the overall picture remains very positive. So if we talk about any corrective action, this is seen as the near-term correction as a part of the larger uptrend. A break above 161.24 is to open our, as the pair already broke above the main bear trend line of 163.08, is to open our next target and very significant barrier, double top at 161.74, 161.78, 17th October and 1st of November peaks to trigger to confirm the basically the bottom at 158.26 that was contained by 200 days moving average, and probably to turn focus towards the upside barriers at our key resistance at 163 zone. As said, dollar yen averted immediate downside risk following a bounce of strong support and the range floor as shown on the 4-hour chart, range floor at 81.70 zone. That was hit yesterday, 81.71 seen in the late US trading with fresh rally higher, recovering approximately 61.8% of the initial down move from 82.74 lower top down to 81.71. A positive tone has been established now on the hourly studies that were quite negative, but still a rather neutral tone seen on the 4-hour chart, where the indicators are ranging around their midlines. See likely scenario for a further sideways movements. Of course, with 4-hour indicators now being in the negative territory, more risk will be seen on the downside. Actually, will keep the downside vulnerable as long as we are holding below 82.50-60. Break of these levels is to refocus our key barriers 82.74 and 82.83 near-term range tops, to break of which to trigger further expansion of the larger uptrend from 77.12 low of 13th of September. That's so far been capped at 82.83, and open levels at 83 and 83.20 as our next upside targets. Conversely, loss of the near-term range floor at 81.70, that was that could be also one of the signals was yesterday's close below 82 as a reference level. Despite the current strong rally, could still be keeping the downside at risk. Break of the range floor at 81.70 is to trigger a stronger corrective action with the 38.2% retracement of 79.06 to 82.83 as at 81.39 seen as the next downside target, ahead of 81.00 as psychological support and near 50% retracement. For now, range is still in play and still keeping the sideways movements following yesterday's bounce higher, but again, failure to regain upside barriers at 82.50-60 as initial resistances could still keep the downside vulnerable, and see risk of retesting the range floor at 81.70, loss of which, of course, to trigger further weakness. Dollar Swiss remains under pressure. A brief consolidative corrective action that was interrupted by a spike. Overall, it was held around 92.70 with spike higher yesterday seen to 92.92. Was all from the corrective action seen so far. 93.00 proves to be quite a tough resistance, and so far keeping the downside, the upside, pardon, protected. Just above this is the daily Ichimoku cloud base we mentioned yesterday, with the Ichimoku studies being firmly negative as the price holds well below the cloud, and the now Tenkan-sen line is also emerging out of the cloud, maintaining the negative tone. Hourly, the 4-hour Ichimoku studies are also firmly bearish, while hourly ones are now attempting below the hourly cloud base, currently at 92.54. According to the studies on the 1 and the 4-hour, more focus is seen towards the downside. However, rather neutral hourly see potential for a further sideways movements, consolidation of the recent fall, with the not much prospect for any stronger corrective action as long as we are holding below 93.00 and another significant 93.39. We're talking about high of 28th of November. This is also close to 38.2% retracement. Any bounce above these levels, especially 93.40 could be a signal for some stronger corrective action. Otherwise, firm focus remains at the downside on our key support at 92.13, low of 17th of October, a loss of which to signal an end of 2 months corrective consolidative, I would say, action of range established between 92.13 and on the upside 95.11, and will signal resumption of the larger downtrend from a yearly peak at 99.70 posted on 24th of July 2012. Gold, as we said, remains under pressure as a fresh low has been posted yesterday at 1691. I think we have somewhere these levels or not. Okay, yes, we do have it here on the daily. As shown on the Fibonacci expansion levels, the gold price broke below 1702. That's approximately a 38.2% expansion of the downleg from 1752 as a part of the larger descent from yearly peak at 1795, with the 50% expansion at approximately 1688 seen in the focus. I think I mentioned it as 1690 as the gold price reached this level. The gold remains under pressure due to current uncertainty on the US, but overall fundamentals are still quite positive. I owe this answer to one of our attendees from yesterday, as Bank of South Korea bought quite a reasonable quantity of gold for their reserves, and also the in case of a deepening crisis in the US, of course, in case of failing to find agreement about the fiscal cliff, most likely some further buying could be likely scenario as the investors would go to protect their investments. Back to the technicals, near-term structure remains quite negative as both 1 and 4 hours power indicators are in the negative territory. Some building up some momentum on the hourly chart is evident, but again, so far being stuck at previous strong support, now acting as resistance 1705 and capped by descending 55 days moving exponential moving average, as MACD holds below its center line, and the RSI already starting to point lower with this initial signs of reversal of stochastic on the hourly chart, seeing a most likely scenario of further extension lower. 4-hour indicators hold in the negative territory, with the current bounce seen as corrective on oversold conditions, as indicators again are either sideways or pointing lower, again more focus seen towards the downside. Unless we see a break above minimum 1712, which is a broken bull trend line, more focus again will be seen as we are in an unobstructed down move from 1752 peak of 23rd of November with the 76.4. Basically, this is 1690 zone, let's call it, is double Fibonacci level, and offered so far good support is 76.4% retracement of rally from 1672 to 1752, along with the 50% Fibonacci expansion. This is seen as our next downside target, as we see the series of lower tops are still keeping the bears firmly in play. And basically, to change the structure and improve the current outlook, we need to see break above 1722 peak of 3rd of December. That would avert immediate downside risk. But as said, a loss of initial and strong support at 1700 zone is now seeing more risk towards the downside, as basically the gold price closed below 1700 yesterday, with the targets as set as 1690 seen as initial target, and then we have 1673 strong support. This is previous low 1672, and the Fibonacci expansion of 61.8%. In case of failure to regain 1721 and avert immediate downside risk, this will be our near-term targets, 1690 and 1672. Of course, break of the later is to signal an extension of the downtrend from a yearly peak at 1795 that was interrupted by the corrective 1672 to 1752 action, with the more bearish tone seen on a break below 1672 that will open 1661 200 days moving average, and the 1654 Fibonacci expansion of 76.4%. And finally, the crude oil regained some ground again following yesterday's spike lower to 87, we said 87.57, with the slight improvement seen on the daily, on the hourly chart studies, while 4-hour indicators are still holding in the positive territory, seeing this move as corrective. Basically, the 55 days moving average contained this spike as the price jumps higher again, regains 89.00. We see the more potential again for possible attempt towards 89.77, 90.00, and then 90.31 as broader weakness of the US dollar continues to keep the oil price supported, but still the trading is still choppy and still lacking momentum to clear our barrier that was hit recently, 90.31 and 90.42 Fibonacci level. This is what we mentioned yesterday, but a positive tone that is now establishing on the daily chart, and requires, of course, a break above 90.42. That will be a confirmation of the of bottom at 84.05, and will open probably open way for a further corrective action, where we have a 90 days moving average at 91.25, and then 92.00 as round figure resistance ahead of 50% retracement at 92.38. Back to the lower time frames, immediate supports 88.29, 88.00, and 87.57 yesterday's low, ahead of more significant 86 zone, where we have a previous lows 86.36, 86.16. Basically, loss of 87.57 and 87.00 would increase the downside risk, and probably refocus the downside levels at 86 zone, and then 85.35. That is for now guarding a key support at 84.05. That was all from my side. I think I spoke enough. If you have any questions, please type them and submit them now. Have some questions about gold and silver. Silver is not that much used as safe haven as gold. Of course, gold is remains the number one, despite sometimes losing this level and being replaced by some currencies. At this point, as I told you, the gold overall picture, I was reading some comments also from the other analysts today, and basically I agree with them. For the overall structure is still quite good for gold. If we take a look at the larger time frame charts, let me just put the chart so you can see it. Let it just come to your screen. Okay, this is a weekly chart for gold. As we can see, basically on a monthly even better, we see from 2001, let's say, where the chart goes back 2000 from approximately $270 reaching nearly 2,000, so it's 10 times more. And this picture, if you are a long-term trader, still keeps gold in very positive tone, and the current movements seen from below the yearly, the yearly peak of and historical peak of 1920, still seen as a consolidation ahead of further extension higher. Of course, if you are a short-term trader, then you will be looking for the lower time frames charts, and definitely it will change your direction. In this case, anyone who is long gold, I think, is making mistake, because breaking the main rule that trend is your friend. If you are against the trend, then of course you are facing increased risk of losing money. In this case, I would say, as I'm not supposed to give any trading advice, but I can say, if you see the downtrend, then of course you are selling. If you see the uptrend, you are buying. If you are near-term, a short-term trader and intraday trader, of course that you will be looking for a selling gold, as we have a clear downtrend series of lower lows and lower highs, and break below some important supports. Of course, this is all defining the downtrend. If we take the indicators that are in the negative territory, again giving bearish signals. Of course, as we said, if you take a look at the larger picture, then obviously a strong bull trend of gold. It's still unobstructed with the current reversal from 1920 down to 1520, still seen as corrective, as the yellow metal holds close, rather relatively close to the 1920, and some speculations about $2,000 per ounce are still in play. I would say in this case, yes, it's obviously that the gold is still well supported. I hope the answer was good enough, as I'm not supposed to give any trading signal or any levels or direction, but I can tell you, of course, these are the basis of the trading. Trend up, you are buying; trend down, you are selling, and this is now depends, of course, on the time frames you are using and your frequency of trading. Of course, if you are near a short-term trader and intraday taking intraday positions, you will be following the lower time frames and see that the gold is in the downtrend. Any further questions, please? It seems we have no questions more. In this case, let me just take a look. I think we covered all the questions. In this case, I would like to thank you all for being with us. Any questions, any suggestions, please, you can submit them on the email shown below my picture, analysis@windsbrokers.com. I'll be glad to add any new thing that could be useful for your trading, could be helpful for your trading. Anything that we miss, please don't hesitate to give me suggestions, comments, ideas, whatever you find that could help you. We are here to offer our assistance and help as much as possible. Our next session is tomorrow at the same time at 8 o'clock GMT. Don't forget that we have the release of the most important event of the week, which is the U.S. non-farm payrolls on the Friday, and most likely all the focus is now turned towards there, as pressure regarding Greece and Spain has eased, but of course the main focus remains on the U.S. fiscal cliff. I would like to thank you again all for being with us. Expect to see you again tomorrow morning. Meantime, wish you a very nice day today, and of course good luck in your trading with a lot of profits in your accounts. Thank you.